Pfizer stock is currently trading at $27.56 as of the market close on Friday, April 17, 2026 at 4:04 p.m. EDT. This represents a solid intraday gain of $0.34, or roughly 1.25%, on what turned out to be a relatively optimistic session for the pharmaceutical giant. While the broader market remains closed today, Sunday, April 19, the price action we saw leading into the weekend tells a story of cautious accumulation. For a company that has spent the last 2 years trying to find its footing in a world no longer defined by a global health emergency, this minor uptick might feel like a drop in the ocean, but the underlying mechanics of this move suggest that the big institutions are starting to look at the valuation with a much sharper lens than the retail crowd. The common expectation among most casual investors is that Pfizer is a dead money stock, a former titan of the pandemic that has lost its spark and is now just a high-yield dividend play with very little growth potential left in the tank. People see the fading revenue from those famous vaccines and assume the party is over. However, the reality is starting to look much more nuanced. While the headlines focus on shrinking COVID-19 product sales, the real story for those looking at online investing today is a massive, high-stakes pivot into the oncology sector. Pfizer didn't just buy Seagen for over $40 billion to sit on its hands. They are actively re-engineering their entire business model to become a powerhouse in cancer treatment. The market hasn't fully priced in this shift yet because it's obsessed with the short-term earnings squeeze caused by a rising tax rate and the looming patent cliff. This gap between the public's perception of a fading giant and the reality of an aggressive R&D transformation is exactly where the opportunity lies for anyone using tools like the Fidelity mobile app or a Robinhood account to find long-term value. When you look at the recent trading volume, which hit over 30 million shares on Friday, you can see that this isn't just retail churn. Institutional activity has been quietly picking up as the stock stabilizes in this $25 to $28 range. If you check your SoFi active investing dashboard or use Interactive Brokers trading tools to look at the depth of the book, you'll notice that support is firming up. The sell-off that dominated the last few years seems to have exhausted itself. We are seeing a painful recovery, as some analysts call it, where the company is clearing out the baggage of the COVID-19 era. They've guided for 2026 revenues in the range of $59.5 billion to $62.5 billion, which actually suggests that the floor is finally in. Even with a projected negative impact of $1.5 billion from generic competition this year, the company is still aiming for a 4% operational revenue growth rate when you strip out the pandemic products. This is the definition of a reset year. The daily swings we've witnessed lately are largely a reaction to macroeconomic pressures, specifically interest rate expectations and the rising effective tax rate, which is projected to jump to 15% in 2026. This tax hike is a significant drag on earnings per share, and it's one of the main reasons the stock hasn't made a vertical move higher despite positive clinical trial results. For instance, the recent news about their Lyme disease vaccine candidate showing strong efficacy in phase 3 trials is a huge deal for the long-term pipeline, yet the market barely moved the needle. This is the tension I mentioned earlier. The reality of clinical success is being weighed down by the expectation of immediate fiscal headwinds. Many people using self-investing platforms are getting frustrated by this lack of momentum, but if you look at the Schwab Intelligent Portfolios data, you'll see that the 6% dividend yield is acting as a powerful magnet for income-focused capital, preventing the stock from sliding back toward its 52-week lows. Let's talk about what this company actually is in 2026, because it's not the same company it was in 2021. Pfizer operates through a massive global footprint, selling medicines and vaccines in nearly 200 countries. Their business model is now centered on 6 primary therapeutic areas, with oncology being the crown jewel following the Seagen acquisition. They are moving away from small molecule drugs and into the world of antibody-drug conjugates, or ADCs. These are essentially guided missiles for cancer cells, and Pfizer's pipeline is now packed with them, over 100 projects in various stages of development. This is why Fidelity Wealth Management advisors often include a name like Pfizer in a diversified portfolio. It's a defensive play with a massive call option on medical breakthroughs. While you're waiting for those breakthroughs, you're getting paid a very handsome dividend, which is a core strategy for anyone engaged in online investing for retirement. Comment below if you currently hold any shares of Pfizer stock in your individual brokerage, or if you think the patent cliff is too big of a hurdle for them to overcome. I want to hear your take on whether you're buying the oncology pivot, or if you're looking at more aggressive tech plays instead. Institutional players are also keeping a very close eye on the obesity drug debacle, as it's often called in the press. Pfizer's attempts to enter the GLP-1 weight loss market have been a bit of a roller coaster, but they are still in the hunt.
They are testing oral versions that could be a significant differentiator from the injectable dominance of companies like Eli Lilly or Novo Nordisk. If Pfizer can even grab a small slice of that multi-billion-dollar weight loss pie, the stock price we see today at $27.56 will look like an absolute bargain in retrospect. This is a classic example of how investment help can be used to spot mispriced assets. The market is currently giving Pfizer zero credit for their obesity pipeline, treating it as an expensive failure. But if their phase 2 or phase 3 data in late 2026 shows promise, we could see a massive short squeeze and a rapid re-rating of the stock. The future outlook for Pfizer is a game of patience. The company is currently focused on deleveraging, paying down the debt they took on to acquire Seagen. They have explicitly stated that there will be no share repurchases in 2026. For a lot of Robinhood Investments fans, that's a turnoff because it means no immediate financial engineering to boost the stock price. But for serious investors using Fidelity Brokerage or Interactive Brokers account features, this is a sign of financial discipline. They are prioritizing the dividend and debt reduction, which strengthens the balance sheet for the next decade. The trough revenue year has been a moving target, but we are likely sitting in it right now. The expectation is that 2026 will be flat and boring, but the reality is that the foundation for 2027 and 2028 is being built as we speak through the integration of these new oncology assets. Looking at the catalysts ahead, we have the first quarter earnings report coming up on May 5th. This will be a critical moment for the stock. If they can demonstrate that the $1.5 billion cost realignment program is ahead of schedule, we might see the operating margins start to expand despite the revenue pressure. Additionally, the annual meeting of shareholders on April 23rd could provide more clarity on the capital allocation strategy moving forward. For those utilizing investing sites to track momentum, watch the $27.47 resistance level closely. If the stock can break and hold above that on high volume, it signals that the bulls have finally regained control from the bears who have dominated the narrative for 3 years. In summary, Pfizer is a company in the middle of a profound identity shift. The expectation is that it will struggle to find growth as its old blockbusters lose patent protection. The reality is that it has used its pandemic windfall to buy its way into the most lucrative segment of the modern pharmaceutical industry, oncology, and it is currently trading at a valuation that essentially ignores that future potential. By the time the earnings start to reflect the success of the Seagen integration, the entry point of $27 will likely be long gone. Whether you are using SoFi ETFs, Fidelity IRAs, or just managing a self-investing account, the central insight here is that the risk-to-reward ratio for Pfizer hasn't been this favorable in a long time. The tension between the fading COVID-19 narrative and the emerging oncology reality is creating a window for disciplined investors to build a position in a global leader at a discount. It won't be a fast ride, and there will certainly be more volatility as they navigate the higher tax environment, but the underlying value is becoming too obvious for the market to ignore much longer. The contrast between what people expect, a slow decline, and what is actually happening, a disciplined multi-billion-dollar pivot, is the core reason to keep this ticker on your radar. While names like Tesla stock, Apple stock, or Nvidia stock get all the glory for their high growth cycles, a stable, high-yield giant like Pfizer often provides the necessary anchor for a balanced, intelligent portfolio. Always remember that the most profitable investments are often the ones that feel the most boring at the time you buy them. The authority of this analysis rests on the numbers: a 6% yield, a 20 PE ratio that is beginning to look attractive against forward earnings, and a pipeline that is finally starting to mature. We've seen the trough, and while the climb out won't be a straight line, the direction of travel for Pfizer is starting to point toward a very different future than the one the headlines would have you believe. Be sure to keep an eye on those phase 3 updates and the debt-to-equity ratios as the year progresses.